There is something deeply unsettling happening right now in the gold market, and it's the kind of thing that most people never see coming until it's already too late. Not a headline, not a rumor, an actual structural warning signal buried inside the plumbing of the global gold supply chain. The kind of signal that historically has preceded some of the most dramatic wealth transfer events in modern financial history. And if you own gold, or if you've been thinking about owning gold, you need to understand exactly what this signal means and why the people who are paying closest attention to it right now are moving with a real sense of urgency. So let's talk about what just happened. Gold is currently trading around $4,300 per ounce. That number alone should stop you in your tracks for a moment. Think about where we were just a few years ago. Think about how many analysts were called crazy for even suggesting this level was possible. And yet here we are, and some of the most credible institutions in global finance, from Goldman Sachs to JP Morgan, are projecting that we haven't seen anything yet. Forecasts are circulating for 6,000, 6,300, and beyond by the time this bull cycle exhausts itself. But here's the thing, and this is what this video is really about. The price itself is almost secondary to what is happening beneath it, because something in the supply chain just flashed red, and that signal tells a story that goes far deeper than any price chart. Let me explain what backwardation is, because this is the heart of the alert. In virtually every commodity market in the world, the price of a contract for future delivery is higher than the price for immediate delivery. That makes logical sense. If you want something delivered 6 months from now, the seller needs to be compensated for the cost of storing it, insuring it, financing it. The future price is higher than the spot price. This condition is called contango, and it is normal. It is the default state of almost every market, almost all of the time. Backwardation is the opposite. Backwardation occurs when the spot price, the price for metal you can touch and hold right now, exceeds the price for future delivery. And in gold, this is extraordinarily rare. In fact, for most of gold's history in modern financial markets, it has stayed in contango. The reason is simple. Gold doesn't get consumed the way oil gets burned or wheat gets eaten. It accumulates above ground. There's always theoretically more of it available to lend, lease, or deliver. So contango is the natural state of gold. Except right now, gold is flashing signs of backwardation. And that is not a small footnote. That is the supply chain screaming at you in the only language it knows. What backwardation in gold actually tells you is that physical metal is so scarce relative to demand that the people who need it right now are willing to pay a premium over what they'd pay for future delivery. They can't wait. The immediate supply of deliverable physical metal is tighter than the system is supposed to allow. And when you layer that signal on top of what's happening with gold lease rates, currently running elevated at 1 to 2%, compared to near zero for most of the past decade, you start to understand that the physical market is under genuine structural stress. By the way, if you're watching this and wondering what all of this means for your retirement savings specifically, I've put together a free guide that covers the strategies that thousands of American retirees are already using to protect their hard-earned wealth. It's in the description below, completely free. I'd encourage you to grab it before you finish this video. Now, back to the supply chain. To really understand what's happening, you have to understand how the global gold market actually works, because the way it's portrayed in the media and the way it actually functions are two completely different things. Most people think of gold as something you buy, something you hold, something you can point to, and it is. But sitting on top of that physical market is an enormous, complex, and frankly fragile architecture of paper contracts, leasing arrangements, futures trades, and synthetic positions that dwarfs the actual physical metal underneath it. The COMEX in New York and the London Bullion Market Association, the LBMA, together form the backbone of global gold price discovery. And what most retail investors never appreciate is that the volume of gold traded on these exchanges on any given day is a multiple of the actual physical gold that exists in their vaults. The COMEX has what's called registered gold, gold that is actually available for immediate delivery against a futures contract, and eligible gold, metal sitting in the vaults that has not been designated for delivery. The ratio of paper claims to actual registered deliverable metal has been an area of intense scrutiny among serious analysts. And when physical demand spikes, when investors, institutions, or foreign governments start demanding actual metal instead of paper receipts, the system starts to show its fault lines. This is not theoretical. This has happened before, and the history of those moments is absolutely worth revisiting. because the patterns are uncanny. Cast your mind back to the 1970s. For 25 years after World War II, the dollar had been the anchor of the global financial system. Under Bretton Woods, every major currency was pegged to the dollar, and the dollar itself was pegged to gold at $35 an ounce. It was a promise, a solemn commitment by the United States government that any foreign central bank holding dollars could walk in and exchange them for gold at that fixed rate. For a quarter century, the world operated on that promise. Then, in August of 1971, President Nixon ended that promise, unilaterally, without warning. Foreign governments holding billions of dollars in reserves suddenly found themselves holding pieces of paper backed by nothing but faith. The shock was immediate and profound, and what followed was a decade-long monetary earthquake, inflation that eroded savings, interest rates that climbed into the double digits, oil embargoes, economic stagflation, and gold prices that exploded from $35 per ounce to more than $800 per ounce in just under a decade. Investors who understood the signal that said the supply of real money is getting tighter even as the supply of paper money is getting looser, made generational wealth. Those who missed it watched their savings dissolve in real terms, even as the numbers in their bank accounts stayed the same. And then came 1980. This is the story that almost nobody tells in full, because the full version is deeply uncomfortable for the institutions involved. Bunker Hunt and his brother Herbert were among the wealthiest men in America, Texas oil men who, like many sophisticated investors of the era, had watched the dollar's debasement with growing alarm. They began accumulating silver in the early part of that decade, and as their position grew, eventually reaching somewhere in the neighborhood of 120 million ounces, the price of silver moved accordingly. At its peak, silver touched nearly $50 per ounce. But what happened next is the part that should still make your blood run cold. In a move that has never been fully explained to the public satisfaction, the COMEX changed the rules mid-game. They imposed position limits, they moved to liquidation-only trading, meaning investors could sell their existing positions but could not buy new ones. The Hunt brothers, unable to maintain margin on their massive position as prices were artificially suppressed, eventually faced a margin call that nearly collapsed the firm Bocci & Company and sent shockwaves through the banking system. The brothers declared bankruptcy. Silver collapsed. The lesson the Hunt brothers story teaches is not that commodities are dangerous. The lesson is that when physical supply becomes critically tight, powerful institutions will intervene to protect the paper system. And sometimes those interventions produce violent dislocations that create enormous opportunities for those who are positioned correctly and watching the right signals. Now, connect that story to what we're watching today. The gold market is experiencing a convergence of supply pressures that is genuinely unusual, not alarming in the apocalyptic sense, but unusual in ways that have historically preceded significant repricing events. Start with mined supply. Mined gold production actually hit a record high last year, around 3,672 tons. That's an impressive number. But here's what the headline misses. New gold discoveries have been declining for years. The major deposits found in the 20th century have been largely exhausted. Mining companies have been high grading, a practice where you prioritize extracting the richest ore first to maximize short-term profitability at the cost of long-term resource depletion. Meanwhile, the average grade of gold ore being mined has been falling for decades, which means you have to process more rock to get the same amount of gold. Energy costs are rising, permitting timelines for new mines now stretch to a decade or more in many jurisdictions. The pipeline of new large-scale gold mines coming online is thin. Analysts who track the long cycle of gold production are projecting that total output is near a peak and will likely plateau or decline through the latter part of this decade. Decades of underinvestment in genuine exploration are beginning to bite. At the same time, demand is restructuring in ways that are profoundly bullish for physical supply. For the first time in recorded history, physical investment, bars and coins held by individuals and institutions, is on track to surpass jewelry as the largest single component of gold demand. Think about what that represents. For generations, the gold market was overwhelmingly driven by jewelry, by wedding traditions in India, by gift-giving in China, by decorative demand that, while real, was also price-sensitive and somewhat elastic. When prices rose too high, jewelry buyers pulled back. That demand buffered price swings. But now, the dominant form of demand is not jewelry. It is investment. It is people and institutions deliberately choosing to own gold because they do not trust the alternatives. Bar and coin demand alone jumped over 40% in the first quarter of this year compared to the year before. India's investment demand surged over 50%. China's retail investors, watching their property market struggle and their stock market remain volatile, have been pouring money into gold in record quantities. These buyers are not price sensitive in the same way jewelry buyers are. If anything, rising prices confirm their conviction and attract more capital. Layer on top of that the extraordinary behavior of central banks around the world over the past several years. Central banks, the institutions that are supposed to manage monetary stability, have been net buyers of gold at some of the highest rates in modern history. Not because they're speculating, because they understand something about the long-term trajectory of the dollar-dominated monetary system that they are not saying publicly. Russia began diversifying away from dollar reserves years ago after sanctions demonstrated that dollar-denominated assets could be weaponized. China has been systematically accumulating gold as a percentage of its reserves, even as it works to internationalize the renminbi. Central banks from Poland to Kazakhstan to Turkey have been adding metal. These are not small purchases. These are strategic, deliberate, multi-year accumulation programs. When the institutions whose entire purpose is to manage monetary risk start buying physical gold hand over fist, that is a signal worth taking seriously. And then there's the BRICS dimension, which is perhaps the most profound structural shift of all. The coalition of Brazil, Russia, India, China, and South Africa, now expanded to include several other major economies, has been openly and explicitly working toward reducing global dependence on the dollar as a reserve currency and trade settlement mechanism. The conversations happening in those rooms are about building alternative payment architectures, alternative clearing systems, and potentially alternative reserve frameworks that incorporate gold in ways that the current dollar-centric system does not. We are watching in real time the most serious challenge to dollar supremacy since Bretton Woods. And in every previous historical moment when the dollar's role was under pressure, gold was the beneficiary. Now, here's where the supply chain signal becomes particularly acute. When foreign central banks, major institutions, and large investors start demanding physical metal, not paper gold, not ETF shares, not futures contracts, but actual allocated, audited, deliverable metal, it puts pressure on the exact same COMEX and LBMA systems I described earlier. The vaults that backstop the paper market are not infinitely deep, and the refining and transportation infrastructure that moves gold from mines to vaults to delivery points is not infinitely scalable. Backlogs at major Swiss refineries, shipping logistics challenges, vault capacity constraints. These are not hypothetical. They are being discussed openly by participants in the physical market right now. Gold lease rates climbing to levels not seen in years is one of the clearest early warning systems in the entire precious metals complex. When it costs money to borrow gold, when the people who need metal right now are willing to pay a meaningful rate for temporary access to it, that tells you the deep supply of easily mobilizable physical gold is thinner than the paper market implies. And when you layer backwardation on top of elevated lease rates, you have a compound signal that goes back historically to periods of genuine physical stress. Quick aside here, and I mean this sincerely, if you're sitting on a retirement account worth $100,000 or more, there are specific tax-advantaged mechanisms that allow you to get physical gold working inside that retirement structure without triggering penalties. I put together a free guide that walks through exactly how that works. It's linked in the description below. Whether this is relevant to your situation or not, it costs nothing to understand your options. Now, let me bring this back to what it means for you practically. The scenario unfolding in the gold market right now is not a short-term trading story. It is a long-duration structural story about the collision between an expanding paper claim system and a constrained physical supply base at precisely the moment when geopolitical and monetary pressures are driving the highest levels of physical demand in a generation. When paper claims on gold exceed the physical metal available to satisfy them, and the historical record shows this has happened before, the resolution is almost always a violent repricing upward. Not gradually, not in a straight line, but sharply, sometimes explosively, as the paper system is forced to acknowledge the reality of physical scarcity. The Hunt Brothers episode showed what happens when physical silver got tight. The London gold pools collapse in 1968, when central banks colluded to cap gold at $35 and eventually failed, showed what happens when official price suppression runs out of physical gold to sell. In both cases, The people holding physical metal walked away with extraordinary purchasing power. The people holding paper promises got much less. What makes this moment particularly interesting is the convergence of factors that wasn't present in earlier episodes. You have physical demand structurally shifting from consumption to investment. You have central banks buying at historically elevated rates. You have a geopolitical push to reduce dollar dependence that has never been this organized or this broad. You have mine supply expected to plateau and decline precisely when demand is surging. You have a paper to physical ratio on exchanges that gives thoughtful observers pause. You have lease rates and backwardation signals flashing amber. And you have an institutional consensus, from Goldman Sachs to JP Morgan to State Street, that gold's structural bull market is not over, with price targets that would represent another 50 to 100% increase from current levels. This is not a moment to be complacent. It is a moment to be informed. The irony of the gold market is that the information that matters most is usually the least visible. The price on the screen is the last thing to move. What moves first is the physical market, the lease rates, the vault flows, the backwardation signals, the delivery requests. By the time the price is screaming, most of the easy gains have already been captured by the people who were watching the plumbing. The supply chain signal that just flashed red is that plumbing speaking, and it is saying something important about what comes next. There is a reason that the wealthiest families in the world, the ones whose wealth has survived multiple currency collapses, multiple wars, multiple government confiscations, have always maintained meaningful allocations to physical precious metals. Not because gold is glamorous, not because it pays a dividend, but because it is the one asset that has survived every fiat currency that has ever been printed. The one store of value that governments cannot debase and counterparties cannot default on. Every central bank on Earth holds gold for exactly this reason. They hold it because when the systems built on promises start to crack, gold is what's left standing. The question is never really whether to own it. The question is how much, in what form, and through what vehicle. And that is a question that every person watching this video, particularly anyone within a decade or two of retirement, should be answering right now, before the supply chain signals escalate from amber to red. The window to position thoughtfully is always narrower than it appears. The people who acted in the early 1970s, before the dollar collapsed and gold exploded tenfold, didn't act because they knew the exact timing. They acted because they understood the structural forces and respected the signals. The people who understood what COMEX backwardation meant in 1979 positioned themselves before the final explosive phase of that cycle. The people who read the central bank buying data correctly in the early part of this decade are sitting on substantial gains already, and according to the most credible institutional forecasts available, may not even be halfway through this move. If you've been watching gold climb and wondering whether you've missed it, you probably haven't missed what matters. The supply chain signal flashing right now suggests the structural phase of this bull market is still in front of us, not behind us. The physical market is tightening. The paper system is under stress, and history is remarkably consistent about what happens next. So I want to leave you with this. You've stayed with me through this entire analysis, and I genuinely appreciate that, because the people who take the time to truly understand markets, not just the price, but the mechanics, the history, the structural forces, are the people who make informed decisions, and informed decisions are what protect families through financial uncertainty. For those of you who have watched all the way to the end, I want to offer something specific. If you have $100,000 or more in any retirement account, an IRA, a 401k, a 403b, any qualified retirement vehicle, and you want to truly understand how to put gold to work inside that structure, mention that you watched this video when you reach out through the link in the description. You'll be eligible for a complimentary one-on-one educational web conference. No obligation, no pressure, just a genuine conversation with someone who specializes in helping American retirees understand how precious metals fit inside a retirement planning framework. This is exclusively available to American retirees with at least $100,000 in qualified retirement savings, and it's not something I advertise broadly. The supply chain just flashed red. The question is what you do with that information.